My suspicion is that in the near term, the precious metals market, I'm not saying that the gold price is going to go up 30-fold this time. Some point in time in the middle of the market, leadership changed from gold to silver, and gold and silver performed spectacularly well.
Rick Rule just revealed why precious metals could skyrocket. And if you're not paying attention, you might miss out big time. He's in aggressive mode, and he's about to reveal exactly where the smart money is moving next. If you own gold, silver, or you're looking for undervalued assets with explosive potential, you need to hear this.
What are your thoughts on gold? Do you think it's still a good investment here, or do you think it might be close to topping out?
I don't think it's close to topping at all. We've said in earlier interviews that gold does well during periods of time when people are concerned about the maintenance of their purchasing power in fiat-denominated conventional savings products. And I think those fears are very, very, very well placed. We've done the math before, but for the benefit of those listeners today who haven't listened before, let's go through some of the basic arithmetic around reasons why people might be concerned about the maintenance of their purchasing power in US dollar-denominated savings products. The first is truly ugly, which is to say $36 trillion in on-balance sheet obligations of the U.S. government, or $29 trillion net of the Fed's own balance sheet. From there, we get worse, $100 trillion, which is the net present value of off-balance sheet obligations of the U.S. government, things like Social Security, Medicare, Medicaid, military pensions, federal government pensions, things like that. The net present value of those obligations exceeds $100 trillion. You combine those two numbers, and the net obligations of the U.S. government exceed $130 trillion. The IRS estimates that the private net worth of American citizens, which is to say the wealth that gets taxed to meet those obligations, is only $141 trillion. Now, yes, the obligations pay over time, but remember, this is a net present value number. Meanwhile, the U.S. Treasury, which is to say the obligated party under those obligations, takes in about $5 trillion a year gross before they spend any money, and Congress spends $7 trillion, which is to say, rather than servicing the debt, we increase it by $2 trillion a year on balance sheet, and another $2 trillion a year off balance sheet. If that weren't bad enough, let's give you another piece of math, this one more subtle. The U.S. Treasury, the 10-year Treasury, the world's premier savings instrument, yields, 4.5% today? And if you believe the government's numbers around inflation, you assume that the deterioration of the purchasing power of the U.S. dollar is only 2.6% a year. If that's true, you're making 1.9% on your savings. I don't believe it's true. I don't believe that the CPI measures the deterioration of the purchasing power of my savings. When I look at the basket of goods and services that I buy, and I look at the prices of those goods and services in the period 2020 to 2025, I believe that the real deterioration of the purchasing power of the US dollar is between 7.5% and 8%. If that's true, if the government pays me 4.5%, in a currency where the purchasing power is declining by 7.5%, that means I'm losing 3% a year. And I'm losing 3% a year lending money to a counterparty that's already $130 trillion upside down. No thank you. I think the deterioration of the purchasing power of the US dollar continues because I think the only way that we fund the nominal obligations of $130 trillion is to further reduce the purchasing power of the US dollar. We did it in the decade of the 1970s. According to the Office of Management and Budget, the US dollar lost 75% of its purchasing power in 10 years between 1970 and 1980. Not coincidentally, the gold price went up 30-fold during that period of time. I'm not saying that the gold price is going to go up 30-fold this time, but you asked me how I felt about the gold price. And all of that arithmetic tells me that, well, maybe not immediately, over the next 2 years, 3 years, 5 years, and 10 years, I think gold isn't merely going higher, but likely going much higher, at least nominally, because I see the dollar going lower. I can't do the arithmetic around the fundamentals of silver because despite trying for 50 years. I don't understand them very well, nor, by the way, does anybody else. What I know about silver is that in a precious metals bull market, once gold has established the narrative, once the move in gold has attracted the generalist investor into the precious metals space, that generalist investor generally comes down market to silver pretty quickly. And when that happens, the escalation in the silver price outpaces the escalation in the gold price. I don't know that we're at that place yet. My suspicion is that in the near term, the precious metals market is still a gold-centric rather than a silver-centric market. But believe me, Jimmy, you've been around long enough to know when silver starts to move, you aren't going to have to ask me about it. It's going to be very obvious to everybody. When silver moves, it moves further and faster than gold. And of course, the best performing asset in the class are those very, very, very few high-quality silver stocks. My friend Doug Casey describes the silver stock bull market as the equivalent of trying to siphon the contents of Hoover Dam through a garden hose when the generalist investor comes into a space where the market cap literally isn't big enough to contain them. That $50 number is a nominal number. It's not a real number. It doesn't take into account the fact that the purchasing power of the US dollar has declined very substantially since that $50 number. I don't know what a real number is, but it wouldn't surprise me to be $100. And since I have no idea when or if that goal is going to be achieved, I don't care very much about it. I don't think very much about it. I remember a decently successful investor over time, a guy from Omaha. I think his name was Buffett. Yeah, Warren Buffett once said that all of the factors to consider when you're looking at a market are so broad that trying to do market forecasting is trying to know the unknowable. He suggested that you could spend 15 to 30 minutes a year trying to do market forecasting if it amused you. But an allocation of time that was greater than that was absolutely, completely a waste of time. What I know is in my lifetime, when precious metals markets have attracted generalist investors, some point in time in the middle of the market, leadership changed from gold to silver, and gold and silver performed spectacularly well. Given that I don't know when that's going to occur, I content myself with owning a position in silver stocks and being patient with them. Years can go by and those silver stocks don't pay me rent. But when they pay me rent, the rent that they pay me is truly, truly, truly spectacular. And I don't sweat it much in terms of months or years. I remember, Jimmy, when I came into the business in the 1970s, the price of Coeur d'Alene mines went from 10 cents to $65. Now, sadly, I was too young and poor to take advantage of that. But in the nice market we had in the early part of the 90s, and in particular in the market we had 2000 to 2010, the silver stocks did stupidly well. I did participate in the Silver Standard 72-cent financing and watched that stock in 6 years go to $45. I participated in the Pan American Silver private placement at 50 cents and watched that stock do it at $45. And it didn't do it over my lifetime. It did it over 6 or 7 years. The move from sub $1 to plus $40 in 6 or 7 years makes somebody who is experienced extremely patient in their quest to do it again. Yeah, I absolutely do, Jimmy. It's true that there are many other businesses that compete for investors' attention, some of which broad tech deservedly so. Here's a bit more arithmetic. I know the audience prefers narrative to arithmetic, but I prefer arithmetic to narrative. The market share of precious metals and precious metals securities in the U.S. economy is less than 0.5%. Maybe a little higher today, given the deterioration in price in some of the other classes. Suffice it to say, less than 0.5% of all the savings and investment assets in the United States are denominated in precious metals and precious metals-related securities. According to J.P. Morgan Chase, the median market share of this asset class is 2%. Gold, silver, precious metals don't have to defeat the treasuries. They don't have to defeat the tech stocks. You don't have to do anything like that. All they need to do is return to mean. If they return to the 40-year mean, demand for this asset class quadruples. Given that prices are set on the margin, can you fathom the price appreciation that you can see if their market share reverts to mean, which is to say, demand quadruples?
Rick Rule just laid out the roadmap. Now the question is, are you ready? If you found this insight valuable, smash that like button. And don't just stop there. Hit subscribe and turn on the bell icon so you never miss game-changing updates like this. Big moves are happening. Make sure you're ahead of the curve.